All right, good morning, ladies and gentlemen. Welcome back to Macro Ace with your host, Tony. Haven't done a video in what feels like a while, but it's actually been a whole week. But thank you very much for joining me live. Don't forget to like the video, share it with your fellow traders and friends if you've already seen my videos in the past and found it useful. And also don't forget to subscribe to the channel. But US consumer spending, of course, today we'll be focusing on the PC price index. That is the key measure that's probably going to have the biggest effect on the markets today, and also for future sentiment as well, but might not alter the Fed's path, as we've already heard from Powell yesterday, who's changed his has changed his tune compared to what we've seen in the past. But first of all, let's understand what US consumer spending is, and let's go through that here. So, what is US consumer spending? It shows how much consumers are spending on goods and services within the US. And then we have the PCE price index. Now, the PCE price index and the CPI price index are similar. They measure inflation in the US, but they're measured in slightly different ways. So the CPI measures urban area inflation, whereas the cities and towns. Whereas the PC price index, however, has an overall measure of what's going on in the rest of in the country as a whole. It also puts less of a weight of importance on energy, and it's not measuring a fixed basket of goods, which the CPI price index does. So the CPI price index can be more volatile than the PC price index. The PC price index can kind of chop and change what it measures and looks at. So, for example, let's say chicken prices have become very expensive. CPI price index is measuring that, but in actuality, beef prices are what consumers are buying more of compared to chicken prices. So the PC price index might look at beef prices rather than chicken prices instead. So it's not restricted; it's malleable and dynamic to kind of get a true sense of what inflation is like within the USA. Then, as said, it also includes rural areas as well, and also talking about the businesses that spend on behalf on organizations that spend on behalf of households as well. So, how does it affect the markets? Okay, so the currency, a healthy increase in personal incomes and spending. It usually bodes well for the US dollar. High consumer spending usually encourages more growth and puts upward pressure on interest rates. As we've seen so far, with all the inflation reads, putting aside the consumer spending data itself, whenever inflation has come in higher than expected, that's led to an appreciation in the dollar in anticipation of the Federal Reserve maybe taking a stronger rate hike or continuing to raise, or may indicate that the Fed may have to continue raising their rates much longer into the future than previously anticipated. So that's what happens with the currency when you get healthy consumer spending report alongside with an uptick in the PC price index data as well. Now, for the stock market, a higher personal income spending is usually viewed favorably by the stock market. Because that's fueling economic activity and that increases corporate profits. But in this scenario, where the Fed is raising interest rates, they don't want to see signs of inflationary pressures picking up. So if you do see that, if the stock market does see that PC price index is higher than expected, or isn't seeing a slowdown enough in the market's perception, then you can see the opposite effect, where the stock market will see a movement towards the downside instead, out of fear that the Fed may have to continue to tighten for longer, or might go for a stronger rate hike. Then for the bond markets, if you're considering bond yields, higher than expected PCE reading or consumer spending reading can bode well for bond yields. Of course, at the moment, traders are trying to price in how far the Federal Reserve has to go with the interest rate hikes. If you do get a higher than expected read, then that means bond yields can also see a higher movement or an appreciation as well. However, if you do see if you do see the bond market reacting in a negative way, or seeing some of the bond yields see depreciation. That's because that inflation is, in this current scenario, is slowing down, and that there is less need for hiking further into the future. Maybe take a pause earlier on rather than later on, or maybe reach a smaller rate rather than going for an extremely high rate of interest in the US. But if we're talking about the bond prices, of course, any data affirming sluggishness in the economy is expected to support higher bond prices and lower yields. Again, it's the sentiment and the view that if the economy is not doing well, the Fed will have to either slow down the pace of what they're doing now, or try to support the economy, which would mean that bond yields have see a depreciation instead. Hello everyone, Marin ZGB, and also Scotch and Stocks. Hello, and the engineers, like a group of peeps, or sounds like a music team, or just like a group. Bricktop says hi Tony. Like I said, don't forget to share this video, subscribe to the channel, and also like the video as well. It definitely helps us out. Get that viewership up and going if you like the video. Good day, Pratam Malik. Good day to you too. All right, so the previous report in September then. So within services, the leading contributors were housing and utilities, mainly housing, other services, mainly international travel, and transportation services, mainly air transportation. Within goods, increases in other non-durable goods, mainly prescription drugs and motor vehicles and parts, mainly new motor vehicles, were offset by a decrease in gasoline and other energy goods. So that's just a summary of the kind of the bits more or less important to kind of keep an eye out for from the previous report. Then if we're looking at the PC price index, you had declines were led by gasoline and other energy goods. I think that's obvious with how the energy market has been. Of course, we've gone from early 2022, mid 2022 at around over 100, just over $100, and now we're at around 80. We're kind of chopping backwards and forwards between high and low prices. But energy prices, particularly the crude oil market, markets that we're seeing, and also we are seeing a bit of a depreciation there, which is providing a little bit of alleviation, but it depends on what OPEC wants to do. There's been talks in the past of OPEC wanting to maybe cut by 2 million barrels a day instead, or maybe maintain their current output that they have at the moment. So that's been causing a lot of friction within the energy markets. But for us, or in the US, for the PCE price index, we're not really going to see those effects. Well, now we'll probably have to wait for a little bit longer to see the effects of how it affects the US and consumers as well. All right. Yes, the engineers. Yeah, no, from the Alien movie. If you watched Prometheus, that's the engineers are a very weird race of beings. Probably created. Actually, no, I think the Deacon was an alien. Weird film. Anyways, getting back to economics, away from the engineers. So where is the economy at the moment? So inflation at 7.7% versus 8.2%. And on payrolls was at 261k versus the prior of 263. Retail sales in the US are 1.3% versus 0%. Core retail sales also 1.3% versus 0.1%. Consumer credit at $25 billion versus $32 billion, so a slight decrease there in the consumer credit there. Unemployment rate ticked back up by 0.2% to 3.7% versus 3.5% as the prior. Q3 second estimate GDP came in better than expected yesterday as well at 2.9% versus the prior quarter. Versus the prior quarter of Q2, I should say, of minus 0.6%. University of Michigan 1-year inflation prelim expectations was at 4.9% versus 5.1%. 5-year was unchanged at 3%. So these are all important economic indicators as to kind of expect how strong are inflationary pressures within the US and how strong is consumer spending as well within the US. Is there a bit of a slowdown, or is there still a strong uptick expected? Then if we're looking at the triggers for the economic release today, so consumer spending, with a high estimate, according to economists, they're looking for a high estimate of 1.1%. That's a 0.3 deviation. And with a low estimate of 0.5%. So again, a 0.3 deviation there. Personal income with a high estimate of 1% and a low of 0%. So of course, we're looking at the current forecast for personal income month to month. It's the median estimate is 0.4%. So looking for a 0.6% deviation of personal income on the high end and a 0.4 deviation according to economists on the low end. The PC price index, okay, this is what's going to be very interesting is probably going to sway the market in one way or the other, and might have a strong reaction. PC month to month, the highest estimate according to economists is what they see as 5% with a low of 0.3%. High estimate or the range for the PC price index year on year, 6.1% with a low of of 5.9%. Core PCE price index month to month, a high estimate of 0.4% with a low estimate of 0.1%, and the core PCE year on year with a high estimate of 5.2% and a low of 4.9%. Now, if we're considering the estimates for most of these releases here, but looking at the PCE price index year on year, there's a very small margin of movement that is anticipated from economists, which could rock the markets either way. So if the median estimate for PC price index year on year is 6%, and they're looking, according to economists, looking at a 0.1% deviation on the high end, and then on the low end, you're getting a 0.1 deviation both ways, should I say. So, it shows you how sensitive the markets are to this inflation data and why you should be keeping an eye out on this stuff for how the markets react to it. So those are the triggers there. And if we kind of carry on, so the views then that we have from different investment banks on 19th of November had big money managers believe that an economic slowdown accompanied by still hot price pressures will define trading next year. So they said in their latest fund manager study conducted by B of A, 92% of respondents agreed on stagflation. Citi and BlackRock. So Citi envisions a Powell push scenario in which the Fed is compelled to hike even if the economy slows. I think that's made quite obvious from Powell's comments yesterday, which we'll quickly go through here. Of course, brand spanking new. And BlackRock sees no chance of a soft landing in the US or Europe. So all you've got to know is that either way, whichever way, inflationary pressures are still too hot for the central bank of the US and the ECB. So they will do what they need to do to try and crush that and get towards both of this towards the 2% target. If you remember, back in 2021, then you had the ECB that had the target of close to or 2%. Now they're looking at reaching 2% for their inflation target. So just remember, the Fed prefers the PC price index usually when making forward guidance with where they expect inflation to be. But it doesn't mean that they put off other reprints, and we've seen that in the past with the CPI report as well. Goldman Sachs on the 25th of November. So they said that, so given where it is now, the very real risk of it getting embedded, talking about inflation, into expectations and becoming something of a self-fulfilling problem, you had somebody from Goldman Sachs said that they think the Fed's only option for now is to continue to make inflation the number one policy priority, and that they didn't think that you could preemptively pull back on fighting inflation because of the risk of an unknown possible financial breakage that hasn't yet manifested. So that means that, of course, whenever you raise rates, by a significant amount very quickly, you have these businesses and investment banks that also have to quickly adjust their own funding that they have, their own business accounts, try and adjust for these quick, strong rate hikes. And that puts a lot of pressure on those businesses, and that could cause issues for liquidity for some businesses that might not be able to handle the sudden increase or quick increase in the interest rate. And but it is something that the Fed, from Goldman Sachs' point of view, still need to do to continue to raise rates in order to try and get to their goal as quickly as can. But does that mean that there's going to be a strong recession or a slight recession, or maybe no recession? I think was what Feds Bullard said a couple of days ago. Or there isn't. He doesn't see a chance of a recession. Fed's views then. So November 16th, Fed's daily, non-voter. The consumers, according to contacts, are taking a step back. 17th, Bullard said recent retail sales indicate that the household spending cushion remains intact and a slowdown for the upcoming Christmas shopping season would be acceptable. So that is the summary then of what Daly and Bullard said. Now, if we're considering what Fed's Powell said yesterday, so this is one thing that we need to be aware of and how the markets are moving in general. So Powell yesterday said that slowing down at this point is a good way to balance risks. Okay. Also added that the Fed has been able to look through supply disruptions in the past, and it is unclear that this will continue. And he also said that I still think that there is a path to a soft or softish landing without a severe recession. Also adding that he doesn't want to over-tighten, and cutting rates is not something that they intend to do anytime soon. So I think it's very clear, just, again, with rates being raised, doesn't mean that they're, going to, if they're slowing down their rate hiking path, doesn't mean they're going to reach a high level or high federal funds rate in the future. It just means that they're pumping the brake a little lighter. Okay, so, or think of another analogy. You're sprinting, you're sprinting towards your destination, and then you decide to go into a jog. You go into a jog, and then you kind of slow down and reach your destination, and then pause and, I don't know, take in the atmosphere, or take in the trees and the birds flying around your head. But but that's a good way to kind of think about it if you don't understand what the Fed's hiking path is like and how it can act. So, or sometimes you could have the Fed or central bank that is sprinting, then jogs a little bit, sprints again, to kind of get towards their destination, depending on how they feel. The economy is the person running. So, if we're looking at the deviations, then we've got about 12 minutes. Doing good for time here. Let me bring it up. Here we go. So deviations. All right. Got quite a bit here. Right. 20th of October. Of course, we didn't have it last week because of the Thanksgiving day, which we would have had. So consumer spending, here we go. So you had a 0.2 deviation last time round on the compared to the forecast and the actual figure. And this is how the markets reacted. So overall, the reason why the markets of the S&P 500 or the stock market has seen a positive reaction is that you had two bits of the inflation data, the PCE year on year and core PCE year on year, that it's actually seen a 0.1% decline in their figure. And you had more of a mixed picture if you're looking at the consumer spending or real spending here. Everything else fell in line with expectation. So more or less, it was a blowout economic release for the markets. So you had seen on the S&P 134 ticks towards the upside, Nasdaq 447 up, the Dow 250 up as well. Dolian had seen about 40.5 pips down, Cable 29.4 pips up. So overall, there was dollar weakness. Now remember the brackets. If you're not a subscriber to the Macrays mailing list, of course you wouldn't you don't get access to the deviation Google Sheet. It's free. You can sign up to the macros mailing list. I'll provide that link for you in the chat. Actually, I'll do it right now. Why not? You guys are here. I'll make it fair on you. Before I forget, actually. I do not want to forget that for you guys. All right, that's the macros mailing list. So as I said, you get the deviations of how the economic releases react, or how the markets, react to the economic releases that come out, and how strong the movement is for an economic release. So just to make you aware of what the brackets represent. So first of all, this figure here shows you the initial move going to the wick of the candle, right? Because I want to capture the full movement of what had happened or how big the initial movement was. And this is 10 minutes after trading. This is 10 minutes post the release, okay? Which it doesn't go to the wick, it just goes to where the candle had ended. Of course, it's kind of more important in my point of view, to understand how big the initial market reaction was, to try and capture that as best as I can. So you can see here on the NQ, after 10 minutes of trading, it was still up, from the initial market reaction. It was still up 155 ticks. Whereas you see on the currency pairs, it's a little bit different. It's not a clear or clean cut picture, or one clear direction. That kind of continues its move. The key reason being is that one, you had a positive consumer spending report and more or less a jagged mixed report altogether. So the currencies had seen more of a initial strong movement, but then after about 10 minutes of trading, they kind of more or less made up for any of the either losses or had raised any of its gains, whichever currency pair you're looking at. Again, that's a mixed report that we had seen this sort of reaction. I did have the video for the last report. I don't have it now. Unfortunately, I had deleted it when I didn't want to delete it. So apologies, I don't have a video to kind of show you the market reaction in its past. But that's one thing to consider. So more or less, what you would want. So where you get more of a cleaner reaction for what we've seen is if you do see a mixed report like this again, then you could see the stock market seeing a more of a clear direction, where if you do see PC price index data coming lower than expected, you don't see an overall big, huge figure or huge deviation from consumer spending of at least 0.4%. Then you would get more of a clearer appreciation from the stock market here, as we've seen in the past. However, of course, the market, the data can surprise us where all the data is green, and then you're not really looking at a good day for the stock market, considering that if inflation pressures are still higher than expected, that ain't good. And it could mean that the Federal Reserve tightens for longer and reaches a higher terminal rate. Even if they do go by smaller rate hikes, right? Doesn't mean they're going to reach a really high terminal rate. So, or unless if you do see all the data in red, then the stock market will love it. And then the dollar would probably see a nice depreciation towards the downside, because the data is clearer, presents a clearer picture. All right, we've got about 4 minutes left now. Financial juice is, as said, so we'll not only do have consumer spending, but I've got other economic releases here, and of course FMC as well, providing what if you're trying to figure out why did the market move in a certain way, well, here you go. For the interest rate, I kind of give you a sentiment overall as to what caused the market to move in a certain way. If the rate comes in as expected, but something else is happening, why? Then for the interest rates, that is there for you to make that picture clearer. With economic releases, you don't really have any sentiment behind it or comment to kind of give a clear picture. So that's why I always do it on the interest rates. It's much better to do that there. All right, so let me move that out of the way. We got the deviations there. We escape this. Close that. Here we go. Financial Juice website is up and running. I've got my dollar yen running here. Got the S&P 500. I've got the 2-year bond prices. Okay, so going into the new contract, going to the new year, 2023. Let's get Tick Strike up and running as well. So Financial Juice is where we're going to be receiving the data from in real time data as well. So it is a lickety split quick. And if you don't know what a live voice or text feed service is like, then let me give you a bit of an explainer. So a live voice or text feed is a service providing you with up-to-date, in real time market news or headlines that can have effect on the big trading market. So we focus on the global macro news. So if Fed's Powell says something, which of course yesterday he did, talk about slowing the rate hiking path, pace, and then that caused the S&P to fly like a bird into the sky, right? And then or there could be an economic release that has a market reaction. That stuff is something that this is high level stuff that the big investment banks, the big boys, have access to. Normal retail traders, they might not have access to this, and because it's not something that they're aware of or haven't, seen. But if you have seen it and you are used to it, but you want to have a go with us, you want to have a little play with what Financial Juice is like, then definitely sign up to Financial Juice Pro. So here on the website, what you can see, you have there we go, that's the link there. Yes, I know we have, thank you very much, 3 minutes. 3 minutes left. Da-da-da. Let me get my US releases ready. Before I there we go. Okay, so got for 3 minutes left. So as I was saying, Financial Juice, you have real-time voice and text headlines. So this is where you get the live voice playing through here. And also you have the text feed here. Also in real time, the economic releases here as well. In real time as well, lickety split. I don't know how many times I've said lickety split. Now it sounds like a scam. No, it's not, I assure you. Pretty darn good. We have Drew, who's on the microphone, who's part of the Financial Juice team. So he's got the release today. Big important day. So the headline release is consumer spending. Okay, but then of course the PC price index is probably going to dominate the report today and the markets and how they react. And all right, we'll keep an eye on what the markets are doing. About 2 minutes. I have, bear in mind, put the link in for signing up to Financial Juice Pro in the chat, so you can have a little look at that. I'll go through in a bit more detail about it, but I think I'm too excited for what PC price index, what the PC price data is going to do, and the consumer spending report as well. All right, a minute left. Okay. Okay, less than a minute remaining now. Actually, I need to get gold up as well. All right, so get data in line with expectation. Expect more of a choppy reaction, or you could see the stock market seeing an appreciation. Worse than expected data for PC price index. You could see a strong appreciation in the stock market and a depreciation in the dollar. A better than expected report for PC price index, an appreciation in the dollar, and a potential depreciation in stock market. So 10 seconds. Here we go. Bond prices, get that back up. Okay, are we ready? Yes, we are. Still waiting for the data. Getting the initial jobless claims coming through. That was lower than expected. consumer spending. Come on, son. Well, 0.8%, 0.8%, in line with the forecast of 0.8%. PCE price index, also as expected at 6% for the year-on-year data. The PC price index month on month, spot 3%, lower than forecast of spot 4%. Core PC price index, spot 2%, lower than the forecast of spot 3%. Core PC price index year-on-year, 5%. That's in line with expectation of 5%. Not really seeing a market reaction. That was a bit mixed. All right, so that was yeah, so it wasn't too much of a movement that happened. You are seeing an appreciation in the Dow, the S&P though. So let's kind of summarize what we've seen if we're looking at the data. So you had a mix of data that was in line with expectation. Consumer spending was also in line with expectation. So you'd seen a bit more of a whipsaw, a reaction. The only thing that was positive for the stock market was a decline by 0.1% in the PC price index month on month and the core PC price index month on month. Bear in mind also you had initial jobless claims at the same time as well. It came in lower than expected by 10k, which is also more can be seen as more of a positive thing for the dollar. If you see less jobs being added, if you see less people taking up jobless claims for the first time, and you see a stronger labor market. But yeah, I was expecting more from that. All right, so let's take a look at how much the market's reacted then. Okay, so 31. All right, so this is what I'm going to do. I'm going to go from here. Whoops. Okay, so there's about 29 ticks towards the upside. Dow. Not that much either. About 48. Dollar yen. So nothing really stood out from that report there. It's about 22.5 pips down. Also gold, let's have a look at gold too. Yeah, so more or less just I mean, it did something. But not that much. 2-year bond prices are 10 ticks. Where are we? Oh gosh. Gold, more of a whipsaw, but 32 down. But to be honest, with the way the dollar reacted, it probably would have gone up a little bit and then just kind of dipped. I want to say there's 19 there. So yeah, a whipsaw reaction from gold. Okay, I'll check some of the other currencies too. GBP USD was also usually a big mover, considering how they are compared to the US. Actually, can't really compare the UK to the US, can you? It's like trying to compare a can of tuna to Felix food or something. cats, something that's high end compared to just, I don't know, rubbish. 26 or 27 pips towards the upside on cable there. Yeah, it was really anticlimactic. Yeah, I was expecting a bit more from that Bricktop. It didn't really pump them much. So this is kind of the weird thing, right? So now the markets have, the markets are still hot on how inflation is within the USA, but you're more or less, considering how the markets reacted today, probably going to be looking at a higher deviation in the future, or a very positive a positive report altogether, or a negative report altogether, and then you'll get a stronger reaction. With a mixed report, like I said, you could see a bit of a reaction. It might, there might be more of a whipsaw here, but that's how the markets are reacting. It doesn't mean that the release isn't important. It's just how much the deviations are, and which was the overall direction of the whole report. But yeah, so financial juice, like I said, that's where you got the data live and in real time. Hopefully it's quick for you. I was kind of looking at all these other bits on the screen too as well, but hopefully you can see that nice and quickly. So again, financial juice is a live voice and text service. If you're trading the markets, and you're trading, particularly if you're trading an economic release, or let's say, there's an important meeting minutes that has come out, then knowing why the markets have moved is very key. And that's where a live voice and text feed comes in, and where we can help you guys understand what's going on, what headline might have come out that's called the market move, or, calling out an economic release nice and quickly for you guys as well, and then that showing you, and then obviously giving you a reason as to why, let's say the S&P has jumped up here. If you're unfamiliar with that, then you're kind of going in blind to a degree. Of course, yeah, you can solely focus on technicals. That's fine. But having a mix of technical and fundamental news, that is kind of like the nadir, or the high point of being able to trade the markets. But hey, whatever your trading method is, that's perfectly fine. So, but as I said, we have put out the link for you for Financial Juice Pro, and that is pinned. Also, TickStrike, what I'm using here. Who's familiar with TickStrike in the chat? Is anyone familiar with what TickStrike is? If you are, just give a thumbs up, or a hell yeah, or just say yeah. Yes, whatever. If you're not familiar with what TickStrike is, so TickStrike measures the momentum or the order flow within different assets as well. Bricktop says, oh yeah. But yes, so Phoenix says, yeah, I love it. Good. So if you're not familiar with what TickStrike is, as I said, it measures order flow within the markets, different assets. So TickStrike, so as you can see here, it shows you, in my way to put it, in a better way to put it, is that it shows you the strength of the momentum for either the buying or selling, the momentum that's going on within an asset class. Okay. And you have these numbers and colors here, which you might not be aware of what it is, but the plus number shows the buying momentum, and the minus number shows you the selling momentum. And what's the deal with the numbers? So the numbers go from 1 to 15, and this is the sensitivity level, okay, of when you want TickStrike to kind of show you an alert on the ticker here. So level 1 is the most sensitive to market reactions. So as you can see, if there's a little bit of buying or selling momentum that's going on, then TickStrike will go off and show that there too. If you want to only see the markets when there's a big amount of momentum in either buying or selling as going on, then you can go all the way to level 15, which is the least sensitive to market reactions. So, of course, particularly if you're a day trader or you're scalping, then it's the perfect tool for you to kind of use. Of course, get used to it. See what see what kind of method, kind of way of trading with it works for you. But if you, as I said, if you are, maybe you need to manage your risk, as some fellow traders have told us with their reviews, managing risk, capitalizing on potential opportunities. We're not, of course, use it how you want to use it, whatever way works for you. That's some of the ways that people have told us that they've used Tick Strike as well. So I'm going to put the link here for you. There it is. V Rising said, appreciate the stream. Also really happy with financial service. Thank you very much. Len Newland says, Tick Strike is amazing. The more you use it, the more useful it becomes. Yeah, it's just, I guess it's, of course, everyone has to get used to a product. But thank you very much for your feedback. That is delicious. So, all right. So dollars more or less wiped its initial, or raised its initial loss, whereas the stock market has it's still moving towards the upside from the initial market release. All right, and then finally, of course, don't forget to like the video, share it, subscribe to the channel as well, make people aware of this if you found this information useful as well to you. And of course, the more people we have, the more we can spread the word of the good macro ace to the people on YouTube. And also finally then, so unusual activity. So if you like trading unusual volume activity in stocks, but crypto, futures, Forex as well, then you can join the free beta test group as well of unusual activity, which is here. There you go. There you are. Unusual activity. So again, unusual activity in the stock market or the currency, or if you're looking at the crypto space, futures, then you can also have access to that, which is free. I'm trying to bring it up on the screen to show you guys what I mean. Here we go. So here we are. So this is showing you the strength of the unusual activity volume, right? Of here we go. I've got my futures here. I've got the S&P 500. I've got my Forex here, and that will just kind of show you what's having the big move. So if I go to USD, we're seeing an unusual amount of activity. Oh, well, that looks nice. Sorry, I'm just kind of getting into this here. But this is an unusual activity. Here, I've put in the link for you to have a bit more of a look into it as well. Let me get up the video for tomorrow. So tomorrow we have non-farm payrolls. Okay. Big day for the markets again, hoping for a bit more of a reaction than we had seen today with PC Price Index. So hopefully, of course, if it's non-farm, it will have something. So I'm gonna share the link with you guys so you can join that live stream for tomorrow as well. All right. So this is so the unusual activity data. So yeah, as again said, have a look at the video, have a look at the link which we've posted in the site for you to, or on the feed for you to have a look at. Thank you very much. Join me tomorrow for non-farm payrolls, and take care.